Welcome to Casense.
Imagine you're looking to invest in a business, and you come across Sugar Rush. It's a popular regional bakery chain, packed with customers, moving fresh pastries all day. On the surface, it looks like a perfect acquisition. Then you look at their books and see a headline figure for the year, 5 crore rupees in profit. But before you hand over a check based on that number, you have to ask a critical question. Is all of that money actually generated by selling cupcakes and bread, or is it hiding something else? In finance, that number is called reported EBITDA. It's simply the profit a company claims on paper, right at the beginning, before anyone has done any deep digging. Taking a reported profit at face value is the fastest way to overpay for a business. Companies preparing for a sale naturally want their books to look as attractive as possible, and paper profit is easily staged. To protect yourself, you run what's known as a quality of earnings review, or a QoE. This is the process an investor uses to verify the health of a deal before signing. The goal of a QoE is to find the adjusted EBITDA. You can think of this as the clean, repeatable cash-making power of the core business, stripped of any noise. This diagram shows how the process works. It acts as a bridge. It connects the shaky, unreliable reported profit on the left to a solid, trustworthy adjusted profit on the right. By identifying and removing clever accounting tricks and lucky one-time events, the QoE ensures that, as a buyer, you are only paying for the real profit that will actually continue into next year. Let's build that bridge for Sugar Rush. We start at our 5 crore reported profit and look for non-recurring items. These are financial windfalls or unusual costs that will never happen again. For example, Sugar Rush received a lucky 40 lakh rupee insurance payout this year. Because that won't happen again next year, we have to subtract it. Next, we make run rate adjustments. This means taking a major change that happened halfway through the year and projecting what it would look like over a full 12 months. Sugar Rush opened a successful new location in July. To understand the business's current capability, we double those partial year profits, adding 30 lakh to our total. Then we apply pro forma adjustments. These account for guaranteed changes to the cost of running the business that a new buyer is going to inherit. Right now, the current owner of the bakery manages everything but doesn't take a salary. A new buyer will have to hire a manager, so we subtract a realistic market rate salary of 50 lakh, bringing us to a final adjusted total of 4.4 crore. There's also a final step behind the scenes, where analysts make sure the company isn't using aggressive accounting policies and verify that enough working capital is being left in the cash register. Each of these steps exists to ensure the financial baseline reflects the business as it actually operates today. It protects the buyer from inheriting hidden future costs or realizing cash is missing. Even after building that bridge, there is one final speed check you must run to prove that this newly adjusted profit actually exists as liquid cash. We call this the cash versus profit test. This formula lays out exactly how to test it. You divide operating cash flow by net income. If your result is consistently above 1.0, that is a healthy sign. It proves the company is actively turning its paper profit into real cash sitting in a bank account. But if that ratio drops below 1.0, you have a clear warning sign. It means profits exist on tax documents, but the actual cash is vanishing somewhere in the operation. A strong profit margin means nothing to an investor if the money isn't converting into real liquid assets that can be used or distributed. With our tests complete, we can look at Sugar Rush one last time to apply our reality check to its original valuation. After stripping away the one-time insurance payout, annualizing the new store, and factoring in a real manager's salary, our original 5 crore profit settles into a true adjusted EBITDA of 4.4 crore. Knowing this gives a buyer a distinct edge in negotiations. You can now confidently base your purchase price on that real 4.4 crore, ignoring the inflated figure they presented first. This process helps prevent millions in overpayment by replacing marketing illusions with figures backed by evidence. It allows both parties to negotiate based on the actual performance of the business. However, this framework does have limitations. If you use a QoE blindly, without understanding what goes into it, it can easily point you in the wrong direction. First, buyers must demand hard evidence for every single adjustment. Never accept the seller's math on trust. Second, you should be highly suspicious of any vague, miscellaneous, or unexplained one-time add-backs. Sellers sometimes use these opaque categories to hide core operational failures. You also have to remember that a QoE is not a statutory audit. An audit looks backwards to check for legal compliance. A QoE looks forward to judge the sustainability of future cash flow. When you are evaluating a business to buy, the most critical question is never just how much profit they made. The critical question is exactly what that profit is made of.